Well, hello, and welcome to the Forecaster Learning Center. Today we are going to learn about the instant gratification P&L and how to apply it. This concept has unlocked tremendous value in many companies. I've worked with some extreme cases where it has given them a chance for survival. In college, we only learned the material necessary to pass the CPA exam. This program builds on that foundation and gives you the tools, techniques, and background you will need to be both the financial leader your company deserves and the financial leader you deserve to be. It is our mission at Forecaster to support the development of financial leaders of small to mid-sized companies across the U.S. In other words, it's for you. Are you ready for the journey? Okay then, let's go. The normal reporting of performance metrics for a factory rely on traditional cost accounting practices that are oriented around GAAP compliance. There is another video in the series that covers all the details of traditional cost accounting, so for now, we will only cover the relevant areas. GAAP accounting is designed for outside reporting. I have tried to make it part of the performance metrics, but it just does not work. It requires us to capitalize all the period costs when they are incurred. Essentially, we are stashing them out of sight from everyone running the business. The capitalized period costs are expensed months later when the revenue is recognized. Imagine being in a boat that veered off course and your navigation equipment did not tell you to correct course for 5 hours. Real-time course correction is invaluable in any business. Let's cover some of the basics of traditional cost accounting as used in GAAP statements. There are many types of variances that can be calculated and tracked, but the math is always the same. For this video, we are using fixed overhead as the example. In our example, we have 15,000 earned labor hours for the month. We apply the standard overhead rate at $100 per earned hour. This calculation yields $1,500,000 of standard overhead earned by the production shop. We spent $1,625,000 to produce the product that month, so the variance to the standard earned overhead is $125,000. Now let's go to the balance sheet. In our example, we carry about 2 months' worth of product in inventory at any point in time. The current period standard overhead earned goes into inventory. That same period, we shipped product that consisted of $1,600,000 of standard inventory. Please note that the shipment represented 33% of the inventory. Under capitalized variances, in this case, we started with $500,000 of variances, added $125,000 of new variances, and expensed the variances at the same 33% as we shipped as standard overhead. Now, a quick recap. We earned $1,500,000 of standard overhead, spent $1,625,000, and had a variance of $125,000. We capitalized both the standard overhead and the variance. And then we expensed the standard overhead and the variance related to the shipments for the month. Now, let's head over to the P&L. Standard material, labor, and overhead are based on the product we shipped this period. The variances, however, were incurred 2 months ago when the product was produced and expensed this period. When you look at the numbers on the report, they are not relevant to the performance of the factory in the current period. So why do we show this type of presentation? Because GAAP requires it, we learned it in school, and it has been used by our company for years, if not decades. Early in my career, I worked for a bearing manufacturer. The bearings were about this big, and we sold millions of them a year. One day, the injection molding manager stopped me and he said, "Jeff, our financials always look good before you charge us with all those variances. You're killing us. How do we get rid of them?" I think what he really meant was, how do I get rid of you? I was annoyed, so I quickly said, "Bob, it's not very hard. All you have to do is make as many bearings as you can in the shortest time possible with the least amount of resources," and I left. I'm not sure what happened, but the next month his variances were gone. From that day forward, the injection molding department was incredibly efficient and showed tremendous profitability. Now there was one less thing to worry about, so I thought. The next thing we knew, the ceiling in the factory had collapsed, and there were hundreds of thousands of bearings everywhere. It turns out the manager had figured out that if he just kept producing bearings, whether we needed them or not, his variances would go down, and of course, they did. He made so many that he had to hide them in the ceiling and behind walls so he would not be discovered. As you can see, we were following GAAP on the shop floor, and it caused the wrong behavior. We had lots of inventory, no additional revenue, but the worst part is the P&L showed great results because the variances were artificially low. What message were we sending? Instead of motivating people to put bearings in the ceiling, we want to motivate them to ship them out the door as quickly as they can at the lowest possible cost. The instant gratification P&L is the answer. With it, we can move the discussion from capitalized variance and other complex accounting concepts to focusing management on driving the business. It rewards us for doing well, and when we stumble, we can see it right away and make the necessary course correction quickly. Revenue is first, and it shows the shipments for the month. Next is material. The number is made up of the standard material and the variances for the month. Note that gross margin has been replaced with a new concept called margin after material. The cornerstone of why this presentation works is because direct labor and factory overhead are at actual spend for the month and presented as a period cost. This results in an operating profit that is aligned with shipping more and spending less. The final line item to get to the GAAP profit is a sum of all the other variances. This simple reconciliation shows how the number is derived. The standard shipped amount is $2,450,000 and the actual spend for the month is $2,475,000. This results in an additional spend to the P&L of $25,000. The amortized variances relate to product that was produced 2 months ago. None of this reconciliation is shown to the operating team, but is necessary for GAAP reporting. I was asked by a company to help them with a short-term loan until they got back on their feet. After a review, I told them, "Joe, your business is not doing well, and I'm certain nobody will loan you money. Can you help us get our business to the point where we can borrow money?" I said, "Sure, let's talk Friday." On Friday, Joe said, "Jeff, we're going out of business." I said, what do you mean? Everything seemed to be okay earlier." "Jeff, we lost a large order and will not make it through the month with the cash we have." "Joe, let me take a look at your books. Let me take them home with me over the weekend, and I will give you my thoughts on Monday." I put their P&L into an instant gratification format, and their margin after material was almost 90%. People costs were over 80% of their costs. On Monday, I said, "Joe, after looking at your books, you're only going to go out of business if you want to." "Jeff, what are you talking about? I told you we lost that big order." "Listen, Joe, over 80% of your costs are people costs. I went through your organization chart and developed a plan to pull out enough costs to get you to significant cash positive position by the end of the month. If we use this new format to measure your progress, we can get you out of trouble and keep you there." They sold their company 4 years later and did extremely well. The instant gratification P&L really works, and it's easy to use. Use it. You will be delighted. Thank you for watching. We want to remind you that the content in this video is for you. If there is anything that is not clear, if there is something you need us to elaborate on, if you have any suggestions, we would love to hear from you. You can reach us at the number or email on the screen, and we will get back to you. Please check out our library of videos and simple-to-use tools on the site. They are for you. The videos will walk you through additional topics such as financial planning and analysis, how to shorten your closing cycle, and how to execute an effective business meeting. Our goal is to support you in becoming the best financial leader you can be. Thanks again from the entire team at Forecaster.